Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Chubb, Head of Investor Relations here at Focus Capital.
I'm Chad Schugler, founder and president of Focus Capital.
Today, we're answering a more tactical question. How does refinancing actually work in real estate investing? So what is refinancing in simple terms? I think a lot of people have refinanced certain loans and stuff like that. So what is just refinancing in general? What does that mean?
Essentially, like my personal home we have as well before, like refinancing, essentially you take a new loan on the property to pay off the old loan.
Mm-hmm.
And hopefully there's some sort of benefit there, whether it be a lower interest rate than previous or higher proceeds or loan proceeds than previous.
Mm-hmm.
That's
better terms or capital extraction is kind of like
or a new loan term too.
Oh yeah, So why do investors refinance? The three main reasons I can think of off the top of my head is lower interest rate, extended loan term like you just brought up, or to pull out equity, so like a cash out refinance.
Yep.
How often do we see refinances for lower interest rate versus an extended loan term? And why are those kind of like two of the main drivers?
What's more common in this industry is a refinance to pull equity out,
Mm-hmm.
which is a non-taxable event,
Mm-hmm.
which is awesome. That's when you essentially increase the value, last week's episode, appreciation, right? When you increase appreciation, the property is worth more now. You can essentially take out a new loan, which can pay off the old loan, plus hopefully give back all of your investors' equity or most of it to the investors, and then keep cash flowing for that point in time with a new loan term. That's the most ideal scenario.
So refinancing is often about repositioning capital.
Yeah.
Yep. When it comes to cash out refinance, property increases in value, like you said, new loan based off of the updated value, old loan paid off. Is the difference usually distributed or reinvested?
Distributed, but that you make a very good point there, Jared, because there are some times where refinance, the strategy used can be to actually capitalize a property. So this may be on like a longer hold type deal to where you have a 10-year hold you're planning for, you're at year 5. And usually every 4 to 5 years, there's some sort of capital needs in the property, whether it be new gutters and roofs or new windows or siding or some major tenant improvements in the units, right? So that could be very costly, very capital intensive. Well, rather than go raise more money from other investors or and put your own capital in the property. If the property has increased in value over the first 5 years, then now you can go do a new loan and recapitalize it and pull the equity out, but then put it back on the property to increase the property's value.
Yeah. What are the risks of refinancing? Like, what are the top risks that you can think of off the top of your head?
Well, essentially now you have a new loan amount, you have a higher loan amount, so you've got to sell the property someday for a higher price. So whatever valuation you think you have in the property, you need to be sure that your loan value percentage you're at with that new loan is still conservative. Mm-hmm. So what you wouldn't want to do is, let's say your property increased from $2 million to $3 million over a 5-year period of time, hopefully shorter than that. You wouldn't want to take a loan for $3 million on the property, or 2.5 even, right? It'd be a very high leverage loan.
Yeah.
So that's the risk, is making sure your loan is still conservative.
Yeah. So higher leverage is the risk. What about market timing risk? How does that play into a refinancing strategy?
Market timing risk, maybe expand more on which way you want to go with that.
Well, I think for me, it's like we've talked about how market can drive appreciation, and then that also that like the market details and logistics also affect underwriting and risk mitigation when you're acquiring a property. But when you're refinancing a property, is there anything in the local market that affects that when it comes to refinancing, or the local comps that go into that? Is there any risk when it comes to the market?
I wouldn't say there's a ton of risk there in the market. I would say that if there's risk in the market, that would be risk for the entire deal itself. Refinance or not a refinance. I think the risk you have there too is in a refinance is mostly around, let's call it interest rates. And there could be times, I think you mentioned here a few minutes ago, there could be times where it's not the right move to make. Like if rates have went up and you can only return maybe a third of the capital to your investors, and there's costs to doing that, that may not be the right time to do refinance. You may just want to wait for rates to come back down or a point where you return more capital to your investors.
When you are evaluating a refinance opportunity for something that's in our portfolio, what is that kind of equilibrium point where it's like, yeah, maybe this rate has gone up a little bit, but we're going to be because of the valuation of our property, we're going to be able to return X to our investors. Is that a full cash out refinance? Is that a full capital return that's worth it? Or where does it come and where is that value and where is it worth it?
Yeah, you made a good point. There's two things. Number one is there absolutely is a time to where we would pull the trigger on doing a refinance if the rates have even went up from the previous loan rate, because I think what's more valuable to people is the time value of money, right? Mm-hmm. So if you can return all their capital back or a majority of it, and they can deploy it somewhere else, and the property still supports the new debt, the new higher interest rate, and still can cash flow, that is far more advantageous for wealth creation, wealth velocity, right? Versus just waiting for rates to come back down or be at a lower rate. I would say that'd be a big key there. What's your second part again?
I think the second part is right now I kind of want to we talked about the risks of refinancing, but when does refinancing make sense? So when you're evaluating our portfolio, we've talked about that, like what needs to be true operationally, like before we even consider a refinance, and like what are the things that we look at internally before even looking at interest rates? Like what are those things, and where is that equilibrium point of like he said, there are scenarios that we would take a higher interest rate because the value of the property has gone up so high and that the cash flow can handle the new debt, but we're able to reallocate capital, we're able to return capital, so it's worth it for a few points. But even before like the point thing, what needs to be true operationally about the property to even look into refinancing?
It needs to be stabilized. Like we're not going to do a refinance the property that's still going through a value-add business plan or still getting stabilized. It's got to be stabilized to where it's humming along. And you asked about, okay, what percentage of investor capital do you want to return to investors? Like what's your minimum? Mm-hmm. I'd say what's minimum, what's ideal. Minimum is 50%. Mm-hmm. I don't believe, without running the math in front of me right now, I don't think it's worth it financially to return a fourth the capital back and go. And there's costs with doing a refinancing loan as well. Mm-hmm. I would say 50% and more at a minimum. Ideally, it's 80% to 100% of capital to return to investors. That's the ideal. So we have 3 deals right now that we could refinance. We're just waiting for the NOI, the operating income, to keep increasing to where we can return almost all, if not all, capital to investors.
Yeah. So when refinancing makes sense, you need to have stable income and a stabilized property. I think in improved or increased NOI is another important kind of milestone there. Favorable debt markets. So, obviously favorable terms, we'd love to have a decreased interest rate, but even like you said, that's not a red flag or like a stopping point if it's slightly increased, if the property can handle the debt. And then I also think a clear reinvestment plan on like, okay, if you're going to get new loan terms, what is the new business plan on this new loan, and how long is that hold? And is it advantageous for us to do that? Or is it like, hey, we're going to hold on to it for another 18 to 24 months and then sell the property?
Well, something else there too is like looking at your loan expiration dates. So most of these loans have between a 5 and 10 year term on them, right? Mm-hmm. So if you're in year 3 of 5, you've got 2 years left before you have a balloon payment. Mm-hmm. Then you have to make a move.
Yeah.
Well, the last thing you want to be doing is having them tell you what you have to do, then the bank or the lender, right? Yeah. So you have 2 years now until your loan is coming due to figure out what you're going to do with that loan, whether it's refinance with the same bank or different lender or sell it, for example, right? So that's where you want to be able to do that strategically to plan the refinance out. And one more thing about refinances I would say is important is, this is the reason why I feel like real estate is a beautiful product to invest in, because instead of selling the asset every 2 to 5 years, if you can refinance it and get your money all back out and then stay in the deal, you basically have infinite returns and still retain your tax benefits there.
Yeah. So it sounds like everything that we discussed today, refinancing isn't about just taking money out, but it's also about strategically repositioning capital. And so never be pressured by outside forces, whether it's your lender, whether it's your bank, or even, we're here to service our LPs, but don't even be pressured by LPs to refinance, because you have a fiduciary duty to all LPs, to all your investors, all asset classes, to do what's best for the property and be able to kind of stick as close to that business plan as possible. Last question when it comes to refinancing. Does refinancing require operators to create an entirely new business plan, or can it be a part of the original business plan that is one of the events that could happen within the 5 to 7 year hold?
Not typically. Typically, a refinance will be looking at trailing financials. So typically they'll be taking the property's value today, historical operations, and because you'll be the same operator that will own it, there shouldn't be a big need for an exhaustive business plan going forward. Some lenders may need that just to kind of make sure you have a plan going forward. But from my experience, it's not been a necessary thing.
Got it. Anything else you wanted to add on this subject?
No. Let's do refi this year.
Yeah.
Or two.
Yeah. One or two. We'll see how it goes. All right.
Yeah.
Thanks so much.
Yep.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.